Schedule F, Farm Income and Losses, which are reported on Form 1040, line 18, is a little beyond the scope of this course. So what we'll do is skip the farm income and losses, and we'll start talking about unemployment compensation, which is reported on Form 1040, line 19. Many Americans are collecting unemployment insurance payments, and many are doing so for the first time ever. Some people are left wondering if unemployment payments are taxable or not. The short answer is yes. Unemployment income is taxable. Since unemployment income is treated as normal income, the amount is indeed taxable. Unemployment compensation is includable in gross income. You must report unemployment compensation on line 19 of the Form 1040. Unemployment compensation generally includes any amounts received under the unemployment compensation laws of the United States or of a particular state. It includes state unemployment insurance benefits and benefits paid by a state or the District of Columbia from the Federal Unemployment Trust Fund. If you received unemployment compensation during the year, you should also receive Form 1099-G showing the amount that you were paid. Typically, this amount will show in Box 1. Any unemployment compensation received during the year must be included in income unless you contributed to the fund. And again, unemployment compensation is reported on the 1040 on line 19. So in summary, unemployment is any amount received under an unemployment compensation law of the United States or of a state in the United States. It's reported on Form 1099-G, taxable in most all cases, and it's not considered earned income for calculating the Earned Income Credit. And we'll talk more about the Earned Income Credit in an upcoming module. Now let's move on to Social Security and Railroad Retirement, 1040, line 20. Social Security benefits may be non-taxable or partially taxable depending on the total income from other sources. If the only income received during the tax year was Social Security or equivalent railroad retirement benefits, the benefits are probably not taxable and you probably won't have to file a tax return. This is according to the IRS. How much, if any, of your Social Security benefits are taxable depends on your total income and your marital status. If you received income from other sources, your benefits will not be taxed unless your modified adjusted gross income is more than the base amount for your filing status. You can do the following quick computation to determine whether some of your benefits may be taxable. First, add 1/2 of the total Social Security benefits that you received to all of your other income, including any tax-exempt interest and other exclusions from income. Then, compare this total to the base amount for your filing status. If the total is more than your base amount, then some of your benefits may be taxable. The 2016 base amounts are $32,000 for married couples filing jointly, $25,000 for single head of household qualifying widow or widower with a dependent child, or married individuals filing separately who did not live with their spouses at any time during the year, and $0 for married persons filing separately who lived together during the year. Here's an example of a Form SSA 1099 reporting Social Security benefits. The benefits paid are typically shown in Box 3, and the net benefits show up in Box 5. Here's an example. You and your wife are filing a married filing joint tax return for 2016. You both received Social Security benefits during the tax year. You received a Form SSA 1099 showing benefits of $7,500 in Box 5, and your wife received a 1099 showing benefits of $3,500 in Box 5 on her form. Your total combined W-2 wages for the year turned out to be $22,500. So how much of your Social Security benefits are taxable? Well, here's a worksheet, a quick way to check if the benefits are taxable. The base amount for 2016 is $32,000 for married couples filing jointly. So therefore, in this particular case, none of the Social Security benefits are taxable. We totaled up line A, the total amounts from Box 5 of all the Forms SSA 1099 turned out to be $11,000. One half of this amount on line B is $5,500. The wages, as we were told, $22,500. So the total of lines B, C, and D is $28,000. The base amount, once again, for married couples filing jointly, $32,000. So none of the Social Security benefits in this case are taxable. Now let's assume the same scenario as previously described, except the combined wages in this case are $45,600. So how much of the Social Security benefits would be taxable in this case? Well, once again, the total Social Security amounts, $11,000 in line A, one half of line A, $5,500. On line C, total wages, $45,600. The total in this case of wages and half of the Social Security turned out to be $51,100. So if we look at our Social Security benefits worksheet, we find out on the bottom line, line 18, $9,350 of the Social Security benefits turned out to be taxable. The total benefits are reported on line 20A of the 1040. The taxable amount is reported on line 20B. In summary, we talked about how to determine if Social Security and Railroad Retirement benefits are taxable. If the only source of income, benefits are generally not taxable. If there was other income on the return, complete the Social Security benefits worksheet in order to calculate the taxable portion. Now let's move on to other income on Form 1040, line 21. We use line 21 on the 1040 to report income that's not reported on any other line. In general, you shouldn't use line 21 to report income that's reported on a 1099 miscellaneous form. Generally, income on a 1099 miscellaneous is reported on Schedule C. We don't use line 21 to report non-taxable income such as child support, Roth IRA distributions, gifts received, or inheritances. Some examples of amounts that we would want to report on line 21, other income, include gambling winnings, prizes and awards, fees for jury duty, fees for being an executor, administrator, or personal representative of an estate, canceled debts, and income from an activity not engaged in for profit, such as a hobby. Next, we'll talk about the foreign earned income exclusion. The foreign earned income exclusion allows qualified taxpayers to voluntarily exclude foreign earnings from taxable income. It doesn't apply to members of the armed forces or the U.S. government employees. Taxpayers can't claim the earned income credit or the foreign tax credit if they're using this exclusion. The term foreign country doesn't include U.S. territories or possessions. And we claim the foreign earned income exclusion by using Form 2555 or 2555 EZ. But wait a minute. I thought we were talking about income, not income exclusions. Well, if we look at Form 2555, in Part 8, line 45, we're told to enter the result in this form on 1040, line 21. And if we read the instructions for line 45 on this Form 2555, we're told again to enter the result on line 21 of the 1040 in parentheses. Next to the amount, enter in quotations, Form 2555. And the good news is we get to subtract this foreign earned income exclusion from our income to arrive at a total income on the 1040 on line 22. To be eligible, the taxpayer must demonstrate that his or her tax home is in a foreign country. Taxpayer must meet a period of stay requirement, either what's called the bona fide residence test or the physical presence test. Taxpayer must have income that qualifies as foreign earned income. And for married couples, requirements must be met separately for each person. Taxpayers whose regular place of abode is in the United States cannot be considered to have a foreign tax home and would not qualify for this exclusion. So what is required to meet the period of stay condition? Well, considering the bona fide residence test, a taxpayer must have set up permanent quarters in a foreign country for an entire, uninterrupted tax year. The physical presence test means that the taxpayers must be physically present in a foreign country for 330 full days in 12 consecutive months. So in summary, line 21, other income, includes any taxable income for which there is not a specific line identified. U.S. citizens are taxed on worldwide income and must file a U.S. tax return even if all the income is from foreign sources, and even if they paid or will pay taxes to another country. If the taxpayer is eligible to exclude some or all of the foreign earned income, the taxpayer will complete Form 2555 or 2555EZ. The excludable amount will be entered as a negative number on line 21 of the 1040. And a little beyond the scope of the course, income from the cancellation of debt and distributions from a health savings account. Now let's take a look at some review questions.